This is Nightly Business Report with Sue Herrera and Bill Griffin.
Momentous shift. Apple is moving beyond its flagship smartphone and pushing further into entertainment, marking the biggest strategy change for the company in decades.
Trade dynamics, why the end of the Mueller investigation could put pressure on China to do a deal with the U.S. sooner rather than later.
Charitable giving. Small donations are down since the tax law went into effect, and that's making some nonprofits nervous. Those stories and much more tonight on Nightly Business Report for Monday, March the 25th.
Good evening, everyone, and welcome. Apple today put on a show. One of the world's most valuable companies held an event that was glitzy and enlisted A-list celebrities to help sell its new offerings that include things like streaming video and a digital newsstand. But beyond the dazzle, Apple's big investment is in new services, and it's a major shift in strategy. It sees a future different from its past, which for years has relied heavily on devices and its flagship iPhone. Apple is hoping its big bet will generate billions in new revenue now that smartphone sales are slowing. But investors appeared cautious, sending the stock down more than 1%. Josh Lipton is in Cupertino, California for us tonight.
As you can tell, today's going to be a very different kind of event.
Apple CEO Tim Cook wasn't focused today on the company's bread and butter iPhone business or hardware at all. Instead, it was all about the company's faster-growing, higher-margin services segment. Apple introduced a range of new digital services, but the star of the show was a new video streaming service called Apple TV Plus, featuring original shows, movies, and documentaries from Hollywood A-list celebrities that were here today talking about their new shows, like Steven Spielberg, Reese Witherspoon and Jennifer Aniston, Jason Momoa, and Oprah. With this product, Apple is directly moving into the highly competitive video streaming market.
So I think this is more an advertisement for a longer process to get into the services space. I mean, look, a lot of people are talking about Apple versus Netflix. The bigger issue here is in the U.S. alone, you have 85 million households spending more than $100 a month on their pay TV services. So it shouldn't necessarily be an Apple versus Netflix battle.
Additionally, Apple debuted an all-new Apple TV app where users can subscribe to channels like HBO, Showtime, and Starz. Apple also launched Apple News Plus, a new subscription service bringing together over 300 magazines and leading newspapers. Apple Card, which it bills as a new kind of credit card, built into the Apple Wallet app on the iPhone, as well as an actual physical credit card designed to work where Apple Pay is not accepted. Finally, Apple teased a new service for gamers too, called Apple Arcade, a subscription service that will feature over 100 new and exclusive games launching in the fall. All of these new products arrive as the company's core iPhone franchise has come under pressure. iPhone revenue dropped 15% in Apple's holiday quarter. In response, Apple has been touting its services division as a bright spot, which includes the App Store, Apple Music, and Apple Pay. Services revenue reached nearly $11 billion in the holiday quarter, up almost 20% from a year earlier. Analysts believe these new services are important for a broader strategic reason, too. There's now a base of some 1.4 billion Apple devices in people's hands. Tim Cook has to keep offering all these new fans new, exciting products and services that keeps them loyal to his platform and discourages them from moving to rivals. And if these services really are compelling, it could also give consumers another reason to buy an iPhone in the future. For Nightly Business Report, I'm Josh Lipton, Cupertino, California.
Daniel Flax joins us now to talk about this shift in strategy. He's senior research analyst at Neuberger Berman. Dan, thanks for joining us tonight.
Great to see you.
So you think it'll be a few years before we really decide how successful this strategy shift is? Why?
I think it'll take a little bit of time, Bill, and the reason is they're investing in unique content, but clearly we need to see this content roll out. We need to see how customers respond to it, And this is really, in some sense, just a continuation of what the company's been doing for a long time, which is to invest in ways that enable it to build a differentiated user experience. So we think there's a potentially very attractive growth from a revenue perspective as they move further into the video market, but it's going to take some time.
Now, overall, did you like what you heard from Apple? Do you think this will be an effective strategy to boost up revenues as iPhone sales have been leveling out and in some cases declining?
I think this can contribute to faster revenue growth over the next few years, but I think it's just a piece of it. First, just to address the point on iPhone, the iPhone was weak, and it's the market for smartphones, and certainly in China, is weak at the moment. Apple's also suffering from having a difficult compare on a year-over-year basis. But I think just to address the iPhone issue, the users are satisfied, the install base is growing. I think when you take the services business, video, gaming with the arcade offering, news, payments, these are things that are really reaching into different parts of users' lives and are doing it in a way that is secure, transparent, and really private. And that is, I think, what Apple users appreciate and ultimately will value from the company over the next few years.
As we've learned from Netflix and from Amazon, producing original content can be very expensive. They've already said Apple's planning to spend about $1 billion right away on new content. But do you think that Tim Cook and or shareholders have the stomach to spend a lot more money in case they have to?
I think they do, and I think part of what will determine the level of patience, if you will, is just how successful some of the initial offerings are. The fact that Apple has been able to partner with really visionaries and accomplished artists like Oprah, like Steven Spielberg, speaks to the potential power of what they can do. And so if we see as shareholders signs of early success, then I think the company will have a little bit more latitude to spend aggressively, assuming, of course, that they're continuing to execute in other key parts of their business.
Indeed. Daniel Flax with Neuberger Berman. Again, thanks for joining us tonight.
Thank you.
On Wall Street, stocks struggled to find direction today. The major averages flip-flopped between gains and losses as investors remain concerned about the health of the global economy. And the yield on the 10-year Treasury hit its lowest level since 2017. When all was said and done, the Dow Jones Industrial Average rose 14 points to 25,516. The Nasdaq fell 5 and the S&P 500 was down 2.
And as you saw there was little reaction in the markets today to the completion of the special counsel Robert Mueller's investigation. In his summary of the Mueller report given to congressional leaders on Sunday, Attorney General William Barr revealed that Mueller's investigation did not find enough evidence that President Trump's 2016 presidential campaign colluded with Russia. So now that presumably means that Wall Street's attention turns to trade, because the conclusion of the Mueller investigation could change the dynamics between the U.S. and China as negotiators work on that new deal. Kayla Tausche explains.
President Trump, satisfied with the findings of special counsel Robert Mueller and Attorney General William Barr,
we're glad it's over,
enters the home stretch of trade talks with China emboldened. His top two officials head to Beijing for one day of negotiations Thursday. Vice Premier Leo Hub returns to Washington April 3rd. A senior administration official said the U.S. hopes it can clinch a deal in the days to follow, with a signing summit at Mar-a-Lago later in the month, 2 years after the leaders met to discuss the re-emerging North Korea threat and an early trade deal that got shelved as tensions escalated. In the time since, and with a positive Mueller report, the U.S. may have the upper hand, says Strategas Research.
Now that it's clear the president's going to be in office for the next 2 years or till the 2020 campaign, does China now say, oh, we got to make a deal?
So far, both sides have found the concessions lacking. China has offered to buy $1.2 trillion in U.S. goods. Trump has told his team he wants more. China passed a law changing foreign investment rules. The U.S. wants to be able to retaliate if those laws don't actually change anything. The U.S. has suggested it would remove most of its tariffs as part of a deal. China wants them all gone. Former Treasury Secretary Jack Lew said China has disappointed him in past negotiations, but that de-escalation between the two largest economies would be a good thing.
The sensitivity of market decision makers to the up and down news from the trade discussions is not good for the economy.
There are still questions about how the deal will address criminal charges against Chinese telecom Huawei or cybersecurity. The Russia investigation may be closed for now, but U.S. intelligence chiefs say China could join in interfering in the 2020 election. For Nightly Business Report, I'm Kayla Tausche in Washington.
New market trends are also emerging. The major indexes are recovering from that rocky end to 2018, but individual sector performance has been uneven. Mike Santoli explains.
Even before Wall Street's stumble from a 5-month high in recent days, the performance of the market had been quite uneven, with select groups of stocks leading and many others wallowing. As in the broader society, this divide between haves and have-nots has triggered a debate about what it means for the long-term health of the market. The tape has shown a strong preference for very big stocks over smaller ones, organic growth companies over economically cyclical plays, and groups offering a reliable stream of cash flow and income over almost all others. This has made for an unusual mix of leaders for a market up some 12% so far this year. The giants of tech are back in favor, with Facebook, Microsoft, Apple, and Amazon powering the Nasdaq higher, judged as having durable businesses and reliable profits for many years to come, no matter the economic pace. But humble utilities and real estate stocks are also near record highs as steady dividend income regains appeal in a world of collapsing bond yields. On the losing end, bank shares reeling from those same skimpy bond yields, and retail and transportation stocks hindered by nagging fears over how much life remains in the economic expansion cycle. Some strategists are raising concerns that the rally has been insufficiently broad, with fewer than half of all issues trading above their 200-day average, which is a shorthand definition of an uptrend. Yet an alternative view holds that this is simply the market's way of rotating toward relative safety and certainty during a global economic soft patch, as investors await more clarity on the economy and profit growth in the year's second half. Something like this pattern played out in 2016 after another skid in the world economy. Stock market inequality isn't always comfortable to see, but Wall Street bulls are betting that it's just a phase and not the new normal. For Nightly Business Report, I'm Mike Santoli.
Elsewhere, the president of the Chicago Fed said today that while the U.S. economy has slowed, he does not see the real risk of a recession. Charles Evans expects 2% growth this year, and he described the world's largest economy as being robust, primarily because of the strong consumer and labor markets. And of course, as we've been reporting, the Fed held interest rates steady last week and indicated that no more rate increases will be coming this year.
So with the Fed on hold for the rest of the year and the Mueller investigation behind us, what will the markets turn its attention to at this point? Joining us to talk about that is Joe Zeidel. He's Chief Investment Strategist at Blackstone. Joe, welcome. Nice to have you with us.
Thanks. Thanks for having me on the program tonight.
Even though we have those two kind of headline risks out of the way now, you still see some volatility for the market ahead. Why?
That's right. I think we will see some volatility in the months ahead because we have this tug of war where on one side we had the Fed and the possibility of a trade deal with China, and I think most of that's been priced in. Right? Stocks have had one of their best starts to the year since 1991, and I think that reflects the bullish sentiment on the Fed and China. But on the other side of this tug of war is a realization that corporate profits are really slowing. And corporate profit growth had been a really strong story over the last 2 years. In 2017, corporate profits were up over 10% for the year. In 2018, corporate profit growth accelerated to about 20% for the full year. But as we start to look at first quarter earnings, which will begin to be reported in the next few weeks, there's a realization that profits growth could actually turn negative in the first quarter. And for the full year, it's going to be relatively flat. I think that will drive volatility over the next couple months.
You know, as Mike Santoli just pointed out, for market leadership right now, we sort of have strange bedfellows in the resurgence of technology stocks, but you also have the utilities, among others, that are doing well, of course, because of a low interest rate environment. Where do you see some leadership coming from here?
Well, I think the leadership over the course of the next 6 to 12 months is going to be in the tech sector, but in addition to that, in energy, consumer discretionary, industrials, and materials companies. And what all those have in common is they tend to be pretty cyclical, meaning they're pretty exposed to global growth. And what we noticed in the fourth quarter pullback, where the markets fell about 20% between September and December, is that those sectors led the market down. But even after this 12% recovery year to date, a lot of those sectors are still cheaper than they were back in that September high. So in other words, I think there's still some value in those sectors. So if we do get weakness or volatility over the course of the next couple months, those are the sectors that I'd be looking to add positions to.
Very quickly, does the activity in the bond market and the push lower in yields, does it worry you at all? It has some saying we're headed towards a recession. Others disagree with that.
I think you bring up a really important point. The bond market sent a really powerful and important message on Friday, and that's when short-term interest rates rose above long-term interest rates. That is not a normal phenomenon whatsoever, and that's something that typically only occurs before a recession. Now, when you do see those short-term rates going above long-term rates, the trick is you don't know the timing. On average, that inversion has led recessions anywhere from 12 to 24 months or even longer. And we can't rule out the possibility that there is a false positive in that portion of the yield curve. We still need to see some additional confirmation.
On that note, Joe, thank you. Joe Zeidel with Blackstone.
Thank you.
Time to take a look now at some of today's upgrades and downgrades. Valero was added to the top picks list at Credit Suisse with an outperform rating. The analyst there cited higher distillate margins, among other things. Price target now $105. The stock rose 1% today to $85.48. Regions Financial was upgraded to buy from hold at Sandler O'Neill. The analyst cited the recent sell-off in the stock and says that the bank can continue to slowly grow its loan portfolio. Price target now $17. That stock finished today unchanged at $13.53. And Treehouse Foods was upgraded to buy from hold at SunTrust Robinson Humphrey. The analyst cited the company's focus on private label products and a favorable environment for packaged foods right now. Price target now $70. That's the highest price target on Wall Street right now for that stock, which rose more than 4% today to $63.94.
Still ahead, Boeing moves ahead with software fixes for its now grounded 737 MAX.
American Airlines has been canceling about 90 flights a day because of the grounding of Boeing 737 MAX aircraft, and the airline says that the cancellations will continue through most of April as well. But today, Boeing shares traded higher, something that hasn't happened often over the past few weeks. In fact, it was the best performing stock among Dow components today. Boeing has begun showing pilots how it plans to fix the issues that have grounded the 737 MAX airplanes. Phil LeBeau has the latest developments for us.
Boeing's 737 MAX is still a long ways from being cleared to once again take off. But at the company's facilities outside Seattle, pilots have tested software designed to fix issues suspected of contributing to 2 737 MAX crashes, including one in the Java Sea last October. The software upgrade will still need to be certified by the FAA, and that could take more than a week. Meanwhile, the Department of Transportation is moving forward with its review of how the FAA certifies planes. At issue is whether the FAA has been stringent enough reviewing the self-certification work of Boeing engineers during the development of the 737 MAX. All of this comes as Airbus announces a mammoth order for its competitor to the MAX. A Chinese airline is buying 290 A320s. In a deal with a book value topping $30 billion. The Airbus order has long been expected. Still, given concerns about Boeing's backlog suffering now that the MAX is grounded, Wall Street is taking a closer look at all airplane orders. Phil LeBeau, Nightly Business Report, Chicago.
Winnebago's profits were driven higher. That's where we begin tonight's market focus. The maker of recreational vehicles reported better than expected earnings, but revenue fell short on a decline in RV sales. The CEO acknowledged challenges in the industry over the past 6 months, but also said he hopes the market will stabilize during the third quarter. Shares were off a dime at $29.01. Thermo Fisher plans to buy privately held Brammer Bio for $1.7 billion. The move would push the lab equipment company further into the field of gene therapy, which aims to replace defective genes with healthy ones. The CEO of Thermo Fisher calls Brammer a leader in the industry. The shares rose 2% to $268.80. Eli Lilly disclosed for the first time what it charges wholesalers versus what many patients typically pay for one of its blockbuster drugs. The net price patients pay for its insulin injection Humalog fell by about 8% last year. That is the price paid after factoring in rebates and discounts. The CEO says that disclosure will provide greater transparency into the pricing of medicines. Lilly was up more than 1% to $129.87.
Biogen is buying back $5 billion worth of its own stock just days after halting those 2 late-stage trials of its experimental Alzheimer's drug. The buyback is in addition to its current program that was authorized last year. Shares were up more than 1.5% in today's trade to $220.26. They did bounce back after hitting a one-year low earlier in the session. AT&T has renewed a contract to continue carrying Viacom's channels, thereby avoiding a programming blackout that would have left more than 24 million customers without channels like MTV and Comedy Central. AT&T fell 1% today to $30.77, while Viacom rose 4% to $26.32.
A bizarre turn of events for Nike today. It started with a tweet from attorney Michael Avenatti, who said he planned to disclose what he called a, quote, major high school college basketball scandal involving the company. As you can see, Nike shares dropped and then rose soon after when the Justice Department announced charges against Avenatti for trying to extort $20 million from the athletic retailer. But the story doesn't end there. Avenatti was also charged in Los Angeles with bank and wire fraud for allegedly embezzling a client's money to pay off debts. He was taken into custody in Manhattan this afternoon.
Coming up, a shift in charitable giving is making some grassroots nonprofits nervous. The Federal Housing Administration is making it harder to get a mortgage. The agency that insures mortgages for first-time home buyers is going to begin flagging more loans as high risk. That means that those mortgage applications will now go through a more rigorous underwriting process. The decision could lead to fewer first-time home buyers getting approved for a mortgage.
The state of New Jersey has postponed a vote to legalize recreational marijuana. The measure was put on hold, presumably because it did not have enough support to pass. The legislation calls for taxing the product at $42 an ounce. 10 other states and the District of Columbia have already legalized marijuana for recreational use. It is possible the vote will be held at a later date.
And the state of Illinois is thinking about ditching its flat tax income tax. The governor there, J.B. Pritzker, wants to replace the current system with a graduated rate in order to increase revenue. Illinois, as you may know, has the worst credit rating of any state, and it faces a $3.2 billion budget deficit next fiscal year. Changes to the state's tax code, though, require a constitutional amendment and voter approval. And if it happens, it would likely affect the wealthiest residents in that state the most.
Fidelity wants to make it easier for employers to help their employees give back. The company is launching a program that streamlines the charitable donation process and allows workers to automatically deduct money from their paychecks. That money, in increments of $25 or more, would then be sent directly to the charity of choice. This comes as charities are reporting a decline in smaller donations in light of the recent tax law. And that is causing concern among nonprofits who rely on those smaller, more frequent gifts. Sharon Epperson takes a look at the shift in giving.
Students at the Community Partnership School are settling into their new home. A former factory, empty for decades, is being transformed into a brand new private school, located in one of Philadelphia's poorest neighborhoods.
Everything go okay? Good.
The school is funded almost entirely by charitable donations, which make up 95% of its annual revenue.
Without active philanthropy, this school doesn't exist. So we are concerned and very attentive to, the shift in laws.
That shift is the result of the Tax Cuts and Jobs Act. Under the new tax law, the standard deduction nearly doubled to $12,000 for individuals and $24,000 for couples. Yet only taxpayers who itemize their returns can write off charitable donations and lower their tax bill. Fundraising experts wonder if many taxpayers stop itemizing, how many will also stop giving.
For more modest donors, I think they're probably going to just be giving from the heart, and we're hoping that there's a lot of heart in the American public because charities really can't afford to be losing all these small donors.
Large gifts of $1,000 or more increased by nearly 3% in 2018, but revenue from smaller gifts decreased. Donations between $250 and $999 fell by 4%. While gifts under $250 dropped by nearly 4.5%. It's unknown how much of the drop-off is being fueled by the new tax law. The stock market slide last December, often the busiest month of the year for giving, could be partly to blame. The answer should become more clear as people file their taxes.
We're really worried that over time people see that pattern and they'll say, wow, I don't really have to make a gift to get a deduction. I'm going to get one anyway, so why do it?
A troubling sign for grassroots charities like Community Partnership School that greatly value all donations.
Whether it's $1 million or $10, all in between, it all matters. That's how we fund the school and make it work.
For Nightly Business Report, I'm Sharon Epperson.
And that is Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We will see you tomorrow, hopefully.